Index ETFs versus sector ETFs. Exchange-traded funds, ETFs, have gained immense popularity as a versatile investment tool. Two of the more prominent forms of ETFs are index ETFs and sector ETFs. While both offer a way to invest in a basket of securities, they offer distinctive approaches to investment strategies and objectives. Understanding their fundamental distinctions is crucial for making informed investment decisions. Index ETFs, broad market exposure. An index ETF is designed to track the performance of a specific market index, such as the S&P 500, the NASDAQ 100, or the FTSE 100. These indices represent a broad segment of the market, encompassing a wide array of companies across various industries. The goal of index ETFs is to replicate the returns of the underlying index. With respect to diversification, index ETFs typically offer high diversification due to a large number and variety of holdings. This helps to mitigate unsystemic risk associated with individual companies. As for cost, index ETFs generally feature lower expense ratios due to their passive management style, simply mirroring an index rather than actively picking stocks. When it comes to measuring investor suitability, index ETFs are often favored by long-term passive investors seeking broad market exposure and a set-it-and-forget-it approach. They are a common cornerstone for diversified portfolios. Sector ETFs, targeted industry focus. A sector ETF focuses on a specific industry or sector of the economy, such as technology, healthcare, energy, financials, or real estate. Instead of tracking a broad market index, they track an index composed of companies within that particular sector. The goal of sector ETFs is to provide exposure to the performance of a specific segment of the market. With respect to diversification, sector ETFs offer diversification within a particular sector, but are inherently less diversified than broad market index ETFs. This means they carry more concentrated risk. As for cost, the expense ratios of sector ETFs can vary, but may sometimes be slightly higher than broad index ETFs, especially for more niche sectors. When it comes to measuring investor suitability, sector ETFs are appealing to investors who have a strong conviction about the future performance of a specific industry. They can be used for tactical asset allocation, to overweight a portfolio in a sector an investor believes will outperform, or to hedge against exposure in other areas. The perceived advantages and disadvantages of these two major forms of exchange-traded funds can be summarized as follows. Index ETF advantages. High diversification reduces company-specific risk, lower costs, expense ratios. Simplicity and ease of understanding, ideal for long-term core holdings. Index ETF disadvantages. Returns are limited to the overall market performance, won't significantly outperform a booming specific sector if the broader market is flat. May hold underperforming sectors as part of the broad index. Sector ETF advantages. Potential for higher returns if the chosen sector outperforms the broader market. Allows investors to capitalize on specific industry trends or insights. Can be used for targeted portfolio adjustments. Sector ETF disadvantages. Higher risk due to lack of broad diversification. If the chosen sector underperforms, losses can be significant. Requires more research and active monitoring of sector trends. Can be more volatile than broad market ETFs. With all that being said, what leads investors to select one type of ETF over the other type of ETF? Factors that influence an investor to choose an index ETF. You are a long-term investor seeking broad market exposure. You prefer a low-cost passive investment strategy. You want a well-diversified core holding for your portfolio. You are less comfortable with the higher risks associated with concentrated positions. Factors that influence an investor to choose a sector ETF. You have a strong belief that a particular industry will outperform. You are comfortable with higher risk and volatility. You are looking to make tactical adjustments to your portfolio. You have done thorough research on the specific sector and its prospects. As with any investment, thorough research and understanding of the underlying holdings and associated risks are paramount. For more business, financial, and investment insights and information, subscribe to our channel and visit our website to learn about our financial and investment legal practice. Thank you.